Before you decide to work just one more year after age 60, there's something most people never calculate. They look at their paycheck. They look at their benefits. They look at the extra savings going into their retirement accounts. But they rarely look at the hidden tax costs. And those costs can be substantial. In many cases, the value of an extra year of work is far lower than the paycheck suggests, once taxes, lost planning opportunities, healthcare considerations, and retirement income rules are factored in. Today, I'm going to walk you through 7 important financial costs that can affect people who continue working into their 60s and beyond. By the end of this video, you'll have a clearer framework for evaluating whether an additional year of work is helping your retirement plan or simply creating more tax friction than you realize. As always, this video is for educational purposes only. Tax laws change, and everyone's situation is different. Please consult a qualified tax professional or financial advisor before making decisions about your own finances. Welcome to Decoding Finance. If you're new here, this channel is dedicated to helping pre-retirees and retirees make smarter financial decisions with practical, easy-to-understand explanations. And before we begin, tell me in the comments, how old are you, and are you still working? Just your age and yes or no. Now let's get started. The first cost is straightforward. When you continue earning a salary, that income fills up your tax brackets. Many people focus only on their current paycheck and forget to compare it against what their tax situation could look like in retirement. Years ago, I worked with a couple who were convinced they needed 3 more years of employment before retiring. On paper, that seemed reasonable. But after mapping out their future tax projections, we discovered something surprising. Those extra working years were keeping them in higher tax brackets, while eliminating opportunities that would have been available after retirement. Once they saw the numbers, they realized the decision was much more complex than simply replacing a salary. For many retirees, income declines significantly after leaving the workforce. That can create opportunities to manage withdrawals more efficiently and potentially keep taxable income lower than during peak earning years. The key point is simple. An additional year of salary doesn't just add income. It can also increase the percentage of that income that ultimately goes toward taxes. This is one of the most important concepts in retirement planning. Many professionals call the years between retirement and required minimum distributions the gap years. These years often provide unique planning flexibility. Imagine someone retires at 62. They haven't started required minimum distributions. They may not be collecting Social Security yet. Their taxable income may be lower than it has been in decades. That creates an opportunity to gradually move money from traditional retirement accounts into Roth accounts at potentially lower tax rates. Why does this matter? Because Roth assets can provide tax-free withdrawals if requirements are met, and generally do not create required minimum distributions during the original owner's lifetime. Every year spent working can reduce the number of available gap years, and fewer gap years may mean fewer opportunities to manage future taxes strategically. This doesn't mean everyone should retire immediately, but it does mean the value of those planning years deserves careful consideration. The third cost involves how other income can affect the taxation of Social Security benefits. Many people are surprised to learn that Social Security benefits may become partially taxable, depending on overall income levels. If someone continues working while receiving Social Security, salary income can increase the amount of benefits included in taxable income. I remember speaking with a retiree who assumed his Social Security checks were completely separate from his employment income. After reviewing his situation, he discovered that continued earnings had changed the tax treatment of his benefits. The lesson wasn't that working was wrong. The lesson was that understanding the interaction between income sources matters. A paycheck can influence much more than just the tax owed on the paycheck itself. The fourth cost is often overlooked. It's called IRMAA, which stands for Income-Related Monthly Adjustment Amount. For higher-income retirees, Medicare premiums can increase based on prior year income measurements. One detail catches many people off guard. The calculation generally uses income from earlier years. That means earnings today can potentially affect Medicare costs later. I've seen retirees enter Medicare assuming they would pay standard premiums, only to discover that income from previous working years increased their costs. Again, this doesn't automatically mean retiring earlier is the right move. It simply highlights why retirement decisions should include healthcare planning, not just salary comparisons. The fifth cost is visible on every paycheck, yet many people stop noticing it. Payroll taxes. As long as you continue earning wages, payroll taxes continue as well. Once employment income ends, those payroll taxes generally stop applying to retirement income sources, such as qualified retirement account withdrawals, investment income, or Social Security benefits. Now, it's important to remember that payroll taxes support future benefits and public programs. However, for someone evaluating the value of another year of work, payroll taxes are still part of the overall calculation. The real question becomes, how much additional benefit am I receiving compared to the total cost of continuing employment? Tax laws occasionally introduce deductions, credits, or benefits targeted toward older Americans. The details change over time and often include income limitations. That means some individuals may qualify, while others may not. One common mistake is assuming eligibility without reviewing income thresholds. Your employment income could influence whether certain benefits remain available. This is why periodic tax reviews become increasingly valuable during the transition from work to retirement. Small changes in income can sometimes create larger than expected differences in overall tax outcomes. The seventh cost applies primarily to people who retire before becoming eligible for Medicare. Health insurance can be one of the biggest concerns during those years. Depending on household income and applicable rules, some retirees may qualify for premium assistance through health insurance marketplaces. Employment income can affect eligibility. As a result, the true cost comparison between working and retiring may be more complicated than many people expect. I've seen individuals delay retirement because they feared healthcare costs, only to discover that their actual options were far better than they assumed. That's why running the numbers is essential. Assumptions are expensive. Calculations are powerful. Putting it all together. Now, let's step back and look at the bigger picture. When most people evaluate another year of work, they focus on one number: salary. But retirement planning requires a wider lens. You have to consider income taxes, payroll taxes, Social Security interactions, Medicare premium impacts, retirement account strategies, healthcare costs, future tax flexibility. None of these factors exist in isolation. They interact with one another, and sometimes the combined effect is much larger than people expect. I've watched families spend months debating whether to retire, only to discover that one detailed tax projection completely changed the conversation. Not because retirement was automatically the better choice, but because they finally had the full picture. And better decisions usually come from better information. What you should do next. If you're approaching retirement, here are 3 practical steps. First, estimate how many years exist between your planned retirement date and the age when required minimum distributions begin. Second, review how different income levels could affect your taxes, Social Security, healthcare costs, and retirement account strategies. Third, consider working with a qualified professional who can model multiple retirement scenarios side by side. The goal isn't to retire as early as possible. The goal is to retire at the right time for your financial situation. Final thoughts. The biggest mistake I see is treating retirement as an emotional decision alone. Retirement is also a tax decision, a healthcare decision, an income planning decision, and a long-term wealth preservation decision. The people who often achieve the strongest retirement outcomes aren't necessarily the ones who earned the most. They're the ones who understood how the rules worked and positioned themselves accordingly. So before committing to another year of work, make sure you understand both sides of the equation, not just what you earn, but what that decision may cost. If you found this video helpful, please hit the like button and subscribe to Decoding Finance for more practical retirement and tax planning insights. And in the comments, tell me, which of these 7 costs surprised you the most? I read every comment, and your answers help shape future videos. Thanks for watching, and I'll see you in the next one.